What's up everyone, Dylan here. I wanted to hop on and do another episode of the weekly analysis video. As always, I'll be talking about some of the recent price action we've been seeing, what's been going on in the market, and then going forward, some key areas to look out for, right? So I wanted to start off where we kind of finished last week. I went over how important the June rate cut probability was, okay? I talked about Tom Essay and how he said that the easiest way you can tell if a headline or event really mattered to markets is to look at that June rate cut probability. Okay? Essentially, what I said was if the probability dropped below 50%, that would have been perceived as bearish, and as a result, it would have acted as a headwind for the markets. Okay, and that's exactly what we have seen over the last week. So the last time I posted this video a week ago, that June rate cut probability was sitting at 59.2%. Okay, you could go back to my last video and see that exact figure. I talked about it more. Okay, now if we look at that FedWatch tool, that same metric is at 18.8%. Okay, so simply put, it went from 59.2% down to 18.8%. Why? Because some of the data, inflationary data came out hawkish. We're going to look at those as well. Okay, so because that rate cut probability dropped from over 50% to under 50%, the S&P has come off 3% since I posted that video. Okay, so that's very, very important. I'll continue to keep an eye on those rates going forward. And like I said, shout out to Tom Essay for pointing that out because it worked very, very well. Okay, so what's been happening, right? I wanted to show you guys an email. These charts are from Charlie Bolello. He posts basically like a newsletter every week going over some key charts that, you know, kind of give a good overall sense of what's going on in the market. Okay, so he said very simply, inflation is moving in the wrong direction, right? Overall, US CPI moved up to 3.48% year over year in March from 3.15% in February and 3.09% in January, right? This was the highest headline reading since last September. Okay, that is why that that June rate cut probability went from being, you know, favorable to not favorable. Okay, and that's, like I said, why the market has been switched in terms of sentiment from buying the dip to now selling the rip. Okay, you could see in the background of this email, right? We are seeing lower highs and lower lows being printed. Okay, so a lot of that sentiment has flipped. Okay, now will it continue to stay this way? Right, that's going to be data dependent, and I will show you guys what I will be looking at going forward. But I just wanted to finish off this these pictures. Okay, so not only did the headline CPI print continue higher, but the core print as well moved up to 3.8% year over year from 3.76% in February. Okay, that was the first uptake in core inflation since March of 2023. So over a year. Okay, so why did US CPI increase from 3.1% in January to 3.5% in March, right? Higher rates of inflation in transportation, electricity, right? You could kind of pause this if you really want to look at that, okay? And then he goes on to, more of the specifics, right? The specific transportation costs and retail gas prices, stuff like that, okay? This was also a key point that I liked. The U.S. inflation rate has now been above 3% for 36 consecutive months, which is the longest period of high inflation since the late 1980s and early 1990s. Just to kind of give you guys an idea of how, serious this stuff is, okay? And then this is very, very important, and I've talked about this before on my channel as well. At the start of the year, the bond market was pricing in 6 to 7 Fed rate cuts in 2024, with 25 basis point cuts in March, May, June, and July. Today, after the hotter than expected inflation report, right? The market is now pricing in just 2 rate cuts, with the first cut not occurring until September, right? So essentially, the Fed keeps putting off these rate cuts, and that's what's allowing these higher rates to stay higher for longer, okay? So as a result of that, like I said, it's starting to put some pressure on the market, okay? Also, yesterday, retail sales rose 0.7% versus an expected 0.4%. And a lot of people would think that is good news because it shows a robust economy, but the report was actually too good. It was too strong, as it sparked a sharp sell-off in treasuries, sending the 10-year yield to new 2024 highs. Okay, if we look at the 10-year yield, which is US 10Y on TradingView, and then you could also do TNX. If we go to a daily chart, you could see this thing continues higher and higher. In the near term, it tested this previous swing high from November 13th of last year. You could see that's exactly where it tested today, and then it kind of backed off. So if this acts as resistance and that 10-year yield starts to kind of decline, that could act as a tailwind for the S&P and the other indices for, a dead cat or relief bounce, I should say. But essentially, I would not be surprised if this thing gets back up to that 5% region. It's not going to happen overnight, obviously, but it could certainly get over to that 5% area within the next, quarter, 2 quarters, 3 quarters. And if it does, essentially, in plain English, the higher that thing goes, and if it does get close to that 5% or even above 5%, it's going to be a headwind for the markets, guys, because higher rates will essentially probably and should slow down growth, and that will affect earnings for companies and so on and so forth. Okay, so as far as economic trends go, consumer spending is not going in the right direction. The upward pressure that the strong control group will have on GDP is always a hawkish development, which sends yields sharply higher. Okay, so this uptick in yields signifies mounting investor concern that interest rates might remain elevated for an extended period of time, given the strong retail sales data signaling robust consumer spending, right? That was from a Mentor Q email, okay? That username is on Twitter as well. So essentially, when the economy or the consumer spending is robust, a lot of people say like, oh, that's a good thing, right? It's not, because the more people that spend money, right, it drives up inflation, right? Because the more demand for goods, the higher the prices of those goods will go because the demand's high, right? Basic supply and demand in terms of economics 101. What the Fed wants is that the opposite of that. The Fed doesn't want to see robust consumer spending because that puts, inflation at risk of going higher, right? What the Fed and Powell wants to see is consumer spending start to slow down, because that will deflate a lot of the goods and services prices, and as a result will show, some deflationary trends. Okay, so that's very, very important. So now we're going to get into the actual price action, right? What are we looking at going forward? Okay, so going forward, we had this key, we had this key trend channel on the S&P, and it was holding up very, very well. You could see before it broke down, it acted as resistance 3 different times, and then it acted as support a few times too. And then since then, it has broke below yesterday. So going forward, this is going to be a key area to look out for, right? You want to see this retest at that channel up to, let's say, this 51.55 area, which was support from Friday. So this general area right here is where you want to see the bears defend if you are bearish this market. If price happens to get above that 51.55 and is able to sustain value and really get higher from there, that's not a good sign from the bears. Essentially, you want that area to defend itself, and you want to see sellers kind of hold their ground and defend there. For NASDAQ, same deal. If you're a bear, you want to see price defend this 15,000 or 18,053 area. Okay, you could see very clearly it was acting as clear support. Right, multiple tests down here acting as clear support on each test, and then it finally broke below yesterday on Monday, April 15th, and we have not seen a retest yet. So essentially, you want to see S&P fail there, retest there, and have the sellers defend there, and you want to have the NASDAQ defend here in case of any retests, okay? That's what I'm looking at to the upside. To the downside, we have some demand structure, okay? I'm going to quickly draw this. So we have some demand structure right around the 5,047 area on the S&P, and then the NASDAQ, same deal. You have a demand structure right around 17,725. Okay, so those two areas are going to be key to the downside. The S&P, that demand zone also lines up with SPX 5,000, right? 5,000 is a psychological whole number, okay, which tends to act as support and resistance. Those psychological whole numbers, as a lot of options are tied to that. Option strikes are tied to that. So, some folks with big pockets will try to defend those areas if they're trying to hedge against their options or hedge against their equity longs, so on and so forth. Okay, so essentially, the SPX is 51 points away from that 5,000. Okay, the S&P, very similarly, is around 55 points away from that demand zone. So those two areas should line up if tested. So that's what you want to see, right? S&P, the NASDAQ both have demand zones, as well as SPX having that 5,000 psychological whole number. And then to the upside, you want to see that previous support turns into resistance. And that's how you're going to use, or those are what I would use to gauge relative strength and weakness. So that's about it. Wanted to keep it short and sweet. If you guys like it, give it a thumbs up. I really appreciate anyone who subscribes and supports the channel, as a lot of work goes into these. And as always, I really appreciate recommendations. If you guys want me to talk about some other things and all that kind of stuff, feel free to comment down below. Peace.